Bloomberg Audio Studios. Podcasts, radio, news.
We don't want this to morph into a financial crisis, because that would be politically disastrous for the Starmer administration.
How far are we really from that, though?
We're staring into the abyss here, I think.
That's Philip Saunders, director of 91 Investment Institute, with his assessment of the UK's economic position. So can the Chancellor Rachel Reeves bring things back from the brink? Hello, you're listening to Bloomberg UK Politics. I'm Stephen Carroll.
And I'm Lizzy Burden. Welcome to the programme. Well, Stephen, it is an important week for Rachel Reeves. She's facing MPs for the first time since the government borrowing costs soared to levels not seen since the financial crisis. And that's ahead of some key economic data. Not just the UK's inflation numbers tomorrow, but also the US's inflation numbers. You could see both of those putting more pressure on her economic plans. But just to give you a sense of how important these numbers are, we've had some economists saying that if things don't go as planned, i.e. if inflation in the UK comes in higher than expected, coupled than weaker than expected growth data on Thursday, that could force the Bank of England to intervene. Now, for a Chancellor that's spent the past few months decrying the legacy of Liz Truss, contrasting herself with that spectre, this is a less than ideal position to be in.
Yeah, indeed. And look, it's right that you mentioned the US inflation numbers as well, because this is part of a global sell-off on bond markets that we saw, but the UK was particularly badly affected. We did actually get a bit of an insight into investor views of the UK today. The government sold £1 billion of long-term inflation-linked bonds. Now, that's quite a small amount when you consider the near record amount of borrowing the government's planning on doing this year, but it does give us some helpful indicators. There were just over 3 times the number of buyers as bonds for sale, which is down slightly on a similar auction a year ago, but not dramatically different. It's still a fairly solid number. So investors want to be paid more to lend money to the UK, but they're not being scared away, at least for now. You heard from Philip Saunders from 91 Investment there talking about us staring into the abyss. That's not the first time we've heard those sorts of sentiments from market watchers. Investors will want to know what Rachel Reeves is going to do to rebalance the budget, at least partially, and whether or not she's going to keep to her fiscal rules.
Well, joining us now for analysis is Bloomberg senior economics reporter Phil Aldrick. Phil, just set out for us, how bad is the situation for Reeves?
Well, at the moment, she's going to be in breach of her fiscal rules. And, she set this ambition to have one fiscal event a year to provide clarity and certainty to business and investors in the UK. On March the 26th, this was supposed to just be a set of forecasts and nothing to see here, no policy event attached to it. But she'll have no choice but on March 26th to come back. So, this is a big deal. The bigger risk is that things move even more severely, and she has to sort of set out some policy response earlier than March 26th just to provide some reassurance.
Can I ask a flippant question with a serious undertone? Are fiscal rules made to be broken?
Fiscal rules are made to reassure markets that governments have sort of control of the public finances, and that there are these disciplining forces which will ensure that the national debt doesn't sort of spiral upwards for forever. Are they broken is a different question, and yes, they often are broken, and then you see chancellors come up with new fiscal rules.
But it's the statement of intent that's the important part here, that they have a plan essentially that will improve the kind of debt and deficit situation down the line, even if it's not so great right now.
It is a statement of intent, but you have to take action to ensure that intent is delivered. If you don't, right now, when you speak to people in the markets, that they say the biggest risk is that she abandons her fiscal rules. If she abandons her fiscal rules and lets the deficit rise by more than she's technically allowed to, that will send a more worrying signal to the markets. So this sort of the amount of money involved is really small, right? She left herself 10 billion of headroom, which was way too small. Now in hindsight, we can confirm that. But if she misses her fiscal rule by 2 or 3 billion, in the grand scheme of things, when you've got government spending of a trillion a year, it's kind of irrelevant. But it's all about the symbol that it sends, the signal that it sends, and the sort of symbolism of the sort of fiscal, whether you're prepared to stick to your own fiscal handcuffs. And so it is critical in terms of driving sentiment and confidence in the government.
But isn't she doing exactly what you would advise her to do, in the sense that she said she's completely wedded to her fiscal rules. They're not going anywhere. They're non-negotiable. She's hinted to us that she would, if it came to it, cut spending rather than raise taxes again. That's exactly what everyone in the market's asking for, isn't it? She's not panicking. She's kind of gone ahead to China and emphasised the long-term growth plan. Isn't that really a responsible way of handling the situation? And actually today the market's actually pretty calm.
Yeah, so today's been it's been a sort of reassuring start. The policy of not reacting does appear to be the sensible policy. You don't want to overreact and therefore sort of reinforce or confirm market fears. It's like, oh crikey, we've got something, we thought we had something to worry about. Now even the government is getting worried enough to do stuff. So it's absolutely right. I mean, she is talking about, well, I mean, the signals coming out of government are that it's going to be spending cuts rather than tax rises. She's kind of boxed in by the number of pledges that Labour has made. One of the problems with promising spending cuts is if she does, which some economic and think tank groups are saying that they should just do more cuts at the back end of the Parliament. This is sort of resurrecting this fiscal fiction that the Tories were being accused of. These are sort of promises for the never, promises for cuts in the future are not the kind of thing that you get the sense the markets will tolerate. They'll think, this is a fiction. This doesn't show a commitment to get the job done, and this does raise concerns about, these underlying concerns about the fiscal credibility of the UK, and Rachel Reeves' desire to deal with the debt will be refreshed if that's all she does with these long-term spending cuts.
Do you think that Rachel Reeves' credibility in the city was already gone? And I mean, if she's saying that there'll be spending cuts, that's kind of another fiscal event, if not a budget, isn't it? She's already raised taxes, even though she said pre-election that she wouldn't.
Well, if you're being mean, you could call it a mini budget because of all the associations there. But if it's a fiscal event and it's a few policy tweaks just to make sure she gets her headroom back, you wouldn't call that a budget. These are a bunch of, it could be very meaningful changes to a few policies, but it will not be a broad document with the big visions and all this kind of stuff. So I think she'd like to stick to that. In terms of her credibility, I think that there is a store of goodwill for the Chancellor and for Labour. You saw business swing behind Labour before the election. They've made some unpopular decisions, obviously, on national insurance, payroll taxes since. So there's a pushback. The fundamental agenda that Labour came in for, basically people did support. Obviously, the credibility has been eroded by events since, but I don't think that people are ready to just give up on Labour and Reeves at the moment.
Can markets wait until March, though, before those announcements are made, or will the government have to do something before then?
This is where Wednesday's inflation print is going to be very, very important because, inflation is already due to rise this year. The Bank of England had it rising close to 3% in their forecasts in November.
Which is still way down on where we were.
It's way down on where we were, but they're supposed to be. Yeah, it's supposed to be at 2%. But the risk is now that you've got the NICs, the payroll tax is going to get passed through from April, so that's another price pressure. You've seen energy prices rising. There's been increases in food prices.
Trump's coming.
There's the tariff risk, which obviously is driving the global bond market story. You've got what looks like a very hot US economy again with the jobs market data. So you can definitely see that there are these, in the UK and elsewhere, there are these underlying potential pressures on inflation, and our core measures of inflation are still very high. Services inflation is 5%. So if the inflation print on Wednesday is significantly above where the Bank of England was already forecasting and where consensus is now, it does risk really kind of restarting that bond market sell-off and causing significantly more problems. And then if you follow that with some really weak GDP figures on Thursday, then the story of stagflation in the UK, there is a very strong narrative, for the moment at least, that will support that. And that is kind of what the capital flight that we've seen of sterling falling, gilt yields rising, that combination, that talks to this sort of stagflation fears that we currently have. So this week could really be a big moment. And I mean, obviously as a Brit, I'm hoping it all comes out right and we get higher growth and lower inflation.
But what about the role of the Bank of England in all this? Should they be intervening? What would that look like?
When someone says Bank of England intervention, I sort of panic a bit and think that sounds really bad. Like, how high is the bar for something like that to happen?
But it's not just the Liz Truss situation, right? There's also the question of whether they should end active quantitative tightening to send a signal that they're mispricing UK debt. That's another question.
Yeah, so there's two things. So obviously with the LDI crisis, with Liz Truss's term, fundamentally that was a financial stability intervention because you had a big problem in the financial markets which had to be fixed. So that was,
and this is not the same as that.
This is totally different. So the talk about sort of bank intervention here will be correcting what you can argue is a mispricing in markets. So if normally the bank will do this just through talking, and so for example they have on February the 6th there will be a new set of forecasts from the Bank of England which will set out, will give a very clear indication of what they think of the market path for interest rates at the moment. Back in December, the governor was talking about possibly four rate cuts in 2025. Currently, markets are only expecting one full rate cut. Now, that's a huge change. And if the bank thinks in the last 18 months not that much has changed in the outlook for the economy in the last month and a half, then they'll want to signal again in February that the market path is completely wrong. And this kind of signalling and any comments that accompany it from the governor and others would, in the past, that would basically push down on the market path and it would restore some of Truss's headroom. And one thing that if they don't have time, if we have terrible data this week, people are talking about them making an announcement to send a very clear signal that they will end active QT. There's only about 10 billion of gilt sales still to be done by October. So this will be a small policy in terms of actual sort of what it does to the economy, but it will send a very clear signal that the bank is convinced that the market repricing has got out of control, out of hand, and it's gone way too far. So it's very different to this kind of financial stability intervention with Liz Truss, and the chances of that happening with them coming out and saying we're going to stop QT are very, very slight. So it would have to take some quite big problem this week for it to happen.
Yeah, and look, I note the timing in all of this as well. If we're thinking about the spring statement coming in March, there's a Bank of England meeting only a couple of weeks away on the 6th of February. So perhaps if there were to be some words to be said, that would come at least in order before that as well.
Yeah, I'm also thinking about Rachel Reeves' future in all of this, Stephen. And we had the Prime Minister, Keir Starmer, throwing his weight behind her. I wonder if that's kind of the kiss of death when your Prime Minister has to say to the Chancellor, she'll be with me for the full parliamentary term. Did he need to say that? Is that kind of acknowledging how weak she is right now? Phil Aldrick, I'm sure we're going to be talking about it plenty more over the weeks and months ahead. Our senior economics reporter, Philip Aldrick, with us. Thank you.
Well, that's it from us for today. If you like the programme, don't forget to subscribe. Give it 5 stars wherever you usually listen to podcasts.
This episode was produced by Tiwa Adebayo and our audio engineer was Sean Glastamacchia. I'm Lizzy Burden.
And I'm Stephen Carroll. We'll be back with more tomorrow. This is Bloomberg.
Bloomberg UK Politics. Listen weekdays at noon on DAB Digital Radio in London.